Welcome back to our channel. If you're thinking about selling your business, here's a question you should ask yourself first. Are you and your business actually ready for a buyer's due diligence? We ask that question of every potential client at the very first meeting. And I can tell you from long experience, most business owners aren't ready. Now, it's not because they're dishonest or they have anything to hide. It's almost always because they dramatically underestimate just how deep buyer due diligence goes and how uncomfortable it can be. In this video, I'll walk you through what buyers will look at, why they look at it, and how sellers should think about the due diligence process before coming to market. So what is due diligence? Every buyer, even a mom-and-pop buyer, will perform some level of due diligence before acquiring a business. The only question is how thorough and how invasive that process will be. From the buyer's perspective, due diligence has one goal: to confirm that buying this business still makes sense. That confirmation only comes from understanding every meaningful aspect of the business, the good, the bad, and the ugly. And make no mistake, when you sell a business, everything eventually comes to light. Things sellers often consider minor or mundane can loom very large in the mind of a buyer, especially one who's about to write a 6- or 7-figure check. Even in the best circumstances, buyers are skeptical, and they should be. In small deals, buyers are often risking their life savings, their retirement, their family's financial security. In larger deals, where the buyers are private equity or search firms or family offices, the buyers have a fiduciary responsibility to their investors and owners. Either way, the buyer's motivation is the same. Prove to me that what I think I'm buying is what I'm actually buying. That's why the dive they take into your business can feel deep, tedious, and sometimes even unreasonable. But you have to remember, it's not personal. They don't think you're lying. It's business. It's self-preservation. As a rule, due diligence formally begins after the parties agree to the transaction outline, usually in the form of a letter of intent or a contingent purchase agreement. Along with all the other customary terms that document contains, it should clearly spell out the scope of the due diligence, the timeline of the due diligence, and the buyer's right to ask information. Shortly after the document is signed, the buyer submits their first request for documents. The list will be long, broad, and deep, and it will almost never be the last list. And that's because the first batch of documents almost always raises more questions. This is where the sellers often underestimate the process and where frustration sets in. So let's talk about what buyers actually look at. First up, not surprisingly, are financials. Buyers want to confirm the revenue. They want to confirm the expenses, the cash flow, the hard assets, and most importantly, the true discretionary earnings of the business, what your business really makes. A couple of months ago, we did a multi-part series on determining what your business really makes, its discretionary earnings. I link to that series in the description below. But that financial due diligence means reviewing profit and loss statements for 3 or 4 years, tax returns for a similar period of time, balance sheets, bank statements, real estate leases, especially for escalation clauses. If your books are messy, inconsistent, or poorly explained, buyers will slow down the process, extending the due diligence, as well as any eventual closing. They may even walk. So the next up is inventory. Does the inventory actually exist? Is it obsolete? Is it overstated? Inventory is frequently a source of post-closing disputes if it's not addressed properly before coming to market and during due diligence. About a month ago, we posted a video specifically on how to handle inventory when selling a business. You'll be able to find the link to that video as well in the description below. Next up is corporate status and structure. Buyers want to know that the business is in good standing with all the necessary authorities. They want to know that its filings are all current. They want to know exactly who has the real authority to sell this business. If there are multiple owners, buyers expect to see formal resolutions approving the sale. Now, what about management and employees? Who runs the business day to day? Who holds the institutional knowledge? Who are the key employees, and will they stay? This becomes especially important if the buyer is stepping away completely at the closing or shortly thereafter. Taxes. This is another big one. Buyers want to confirm that payroll taxes, sales taxes, withholding taxes, etc., all taxes are current, fully paid. Certain unpaid taxes have a nasty habit of following the business rather than the seller, and buyers know that. A buyer doesn't want to fear getting a knock on the door 3 years after closing by some tax authority stating that this business did not pay taxes during X period, and you owe them now. Contracts and leases. Every material contract gets reviewed. Customer contracts, supplier contracts, equipment leases, real estate leases. Buyers look carefully for change of control clauses that could alter the terms of any contract or cancel the agreements entirely after a sale. Work in progress. For service business, manufacturers, project-based companies, buyers want to understand what's complete, what's partially complete, what's been billed, what hasn't. Misunderstanding work in progress is another common deal killer. And finally, debt. Buyers don't just take the seller's word for it. They'll look closely to confirm balances with lenders. They'll run UCC searches. They'll look for liens the sellers may not even know exist. Now, given all of that, which is only a short list, but the main items of due diligence, we strongly encourage sellers to perform their own due diligence before they ever come to market. In other words, look at your business the way a skeptical buyer would. Doing this allows you to anticipate objections, prepare explanations, fix problems early, and most importantly, control the narrative. Sellers who prepare in advance look confident and credible. Those who don't lose credibility and can spend months reacting rather than controlling. Now, it's important to note that when a professional business broker or M&A advisor is engaged, most of this information is gathered before the business is marketed. These professionals know how to package a business for sale. In our world, all of this is presented in an offering memorandum, sometimes called a CIM, a confidential information memorandum. The goal of an offering memorandum is simple, and we repeat this in our courses, our blog posts, and our videos. Make it easy for the buyer to buy. Doing so will increase the likelihood of a higher valuation. Give serious buyers everything they need to make a decision pending a site visit and verification. We teach brokers, consultants, and real estate agents how to value, market, and sell businesses all the time. Our courses include lengthy discussions on due diligence, where our clearly and often stated objective is to make the due diligence period one of confirmation rather than one of discovery. If you use this approach, it will significantly reduce the time period in due diligence. It will reduce the number of surprises that are likely to pop up. It will be far less painful, and it will keep deals from collapsing. Due diligence can and probably will feel invasive. It will feel excessive, and in many cases it will even feel unreasonable. But here's the question that every seller should ask themselves. If I were about to invest all this money in this business, how thoroughly would I investigate it? That question usually answers itself, I'm sure you can imagine. The common refrain around here is this: selling a business ain't for sissies. And due diligence where, in our industry, the rubber actually meets the road. If you prepare early, you and your deal will survive it. If you don't, it will expose your business's every weakness and flaw, and it won't look pretty. Now, in our next video, we'll discuss vetting the buyer, determining if they're real or just kicking tires. This is extremely important when it comes to confidentiality. You don't want to be disclosing important information to everybody who asks for it. You need to know that whoever you're giving important information to is a real buyer, this is someone who can pull the trigger. So subscribe so you don't miss that one. If you found this video to be helpful, hit the like button and don't forget to subscribe. In the meantime, thanks for watching, and I'll see you in the next video.